Crowley. I'm a lawyer with Venture Capital Press, and today we're going to be talking about due diligence for startups. This is going to be part one of a couple videos on this subject. So first, let's talk about what due diligence is. Due diligence is a term for when venture investors look at your company and they ask questions to try to understand what the risks are and what the benefits are of investing in your startup. So as an overview, usually the venture capital firm or sometimes an angel investor band will send you what's called a due diligence checklist. What that's going to list are all the documents and all the topics they want to cover to really understand your company. So at a high level, they're going to want to look at financial due diligence. They're going to want to look at whether you have any litigation, who your employees are, if you have employees. Maybe you're trying to call everyone independent contractors. Do you have customer contracts that they can look at? Do you have a capitalization table that shows who owns the stock? And can they see those purchase agreements to know that those people really do own the stock? And is there anything funky in there like a shareholder agreement or restricted stock or buy-sell agreements? There's lots of different topics the investor wants to understand. So the first video that we're going to do, we're going to talk about financial due diligence. So when Kleiner Perkins or Sequoia or another famous venture capital firm or a band of angels like Pasadena Angels wants to look at your startup, the very first topic they're probably going to start with is could you show us your balance sheet and could you show us your income statement? So the balance sheet and the income statement we cover in greater depth in other videos, but the basics for this talk are the balance sheet. The investor wants to see it because they want to know, do you have any assets and what are they? Do you have cash? Do you have Bitcoin? Do you have desks and computers? What kind of assets do you already have so they can feel where your needs are going to be? And if they see on the balance sheet that you only have $1,000 in the bank account, now the fox is in the hen house and they know that you have no money. And so they can ask for whatever terms they want because you are undercapitalized. They'll also want to look at your liabilities. If they see that there are a bunch of loans, they're going to ask who are those people that are loaning money. And if it's the founders that are loaning money, the investor is going to look at that very dimly and say, we're not going to invest our $100,000 into your company or $2 million only to watch that money go back out the door and into the pocket of the founders. So the balance sheet is pretty important and the investors are going to want to look at it. The next thing that they're going to want to look at is the income statement. Now, if you're a first-time entrepreneur and you don't even have a product yet, that may sound a little silly because you're thinking, well, we have no income. But what they want to see is even if the revenue line says 0, they're going to want to look at expenses and they're going to want to see what are you spending your money on today. Is it on office leases? Is it on employees? Is it on software licenses? Are you buying lots of hardware? How are you spending the money and who are you spending it on? So that will be interesting to them. The next thing that they'll want to see is a set of projections. And we also talk about that in another video. But again, in terms of the basics for investor due diligence, they want to see what your assumptions are about the future. So you won't have a projected balance sheet, that would be silly, but you probably will have a projected income statement and maybe something called a cash flow. A cash flow shows at the start of January, we expect to have $1 million in the bank. We're going to not have any revenue, but we're going to have expenses of $200,000. So at the end of January, we'll have $800,000. That will help the investor understand what's your cash burn. That's a term that you'll hear a lot in the venture capital world. They'll want to understand how fast are you spending money right now, and if we give you another $2 million, how fast are you going to spend that? Generally, investors want their money, the money that they give you in your Series A round or your seed round, to be able to at least last for 12 to 18 months. Or maybe if the idea is you're just building a prototype, and after you've built the prototype, then you'll start the real business. They want to understand, okay, will it take you a month or 6 months? What's your assumption on how much it's going to take to actually get through the prototype phase? And the projected cash flow statement will show that to them in very clear terms as to what your assumptions are. The next thing that they might want to do, if your company's been around for a little bit, is they might want to look at your company's tax returns. One, they'd like to see, are you sophisticated enough that you're paying your taxes? But also they want to see what kind of tax treatment you're giving to different items, and whether you're having Uncle Phil do your tax returns, or whether you have an actual CPA firm, and what kind of advice you're getting from those CPAs. So those will all be interesting tests to see, are you surrounding yourself with sophisticated advisors, or are you trying to bootstrap it yourself? And if so, do you have the skills to do that? Why? Well, because the investor's going to give you money, and they want to know that you're going to be a good steward, that you're going to be somebody that can be trusted to actually spend the money that they're going to give you in the way that you're promising, and that you won't mess up their tax returns when they buy shares of stock or a membership interest in your LLC or some other form of equity. So those are all very important topics for investors. Then our next video, part 2, is going to talk about contractual due diligence. Thanks for watching this one. We hope you learned something. Thanks.